Welcome back to On the Beat, everyone. I'm over here with Jeff Farnham from JTS Company, professional mortgage brokers. We want to talk a little bit about, roadblocks. What are the roadblocks that you need to overcome when being approved for a mortgage? And we're talking a little bit about DTI, debt to income ratio. What is that?
All right, so when qualifying somebody for mortgage, there's two ratios we look at.
Okay.
Debt to income ratio and the housing ratio. The housing ratio is simply what is the total house payment going to be, the principal and interest to repay the loan, plus your taxes and insurance, divided by someone's gross monthly income, okay? And we want that, we don't really want to keep that payment around 29 to 30, 33% of somebody's total income.
Okay?
Of
the gross income?
Of the gross income,
okay.
Correct.
Now when you factor those in, is that if you're a single person or is it husband and wife, a couple? Like, do you take both or is it just the single?
So it depends on how many borrowers we have on the loan. If a husband and wife are both borrowing on the loan, we'll use both incomes, both gross incomes to qualify.
Right. Is that the normal practice for a married couple? Well, sometimes it's maybe just the wife or just the husband?
Sometimes depending on what the situation is. One person's credit may be stronger than the other and we don't have to have both on the application, right, to qualify. So it really depends on each person's specific situation. The other ratio we look at is that total debt ratio. And that's a combination of the monthly reoccurring debt, things like car notes, student loans, installment loans, credit card minimum payments, those kind of things. We do not include things like utility bills and insurance costs in that calculation, right? And that'll be take that plus the new house payment, divide that out by the gross monthly income.
All right. What happens if I have too much DTI?
All right, so
how do I bring it down?
Well, there's really only two ways to do that, right? One is to increase income, right? Two is to lower debt.
Okay.
So either, depending on where your debt ratio is, that's one thing we really do. If somebody comes in and their debt ratio is out of line, we don't just say, hey, sorry, we can't help you. We'll sit down and work with you, maybe put a plan together where in 3 months, 6 months, a year down the line, you can be ready.
Okay, and that's super important, I would think, Jeff, that you're working with someone who you know is going to be a great client down the road as well, and you're helping them for financial success.
Absolutely. I mean, it's so important because, everybody's situation today may not be right now, but if we can help them get there, right, at some point in the future, whether that, again, and sometimes it could be as quick as 30 days, depending on what the situation is. But I've had clients that we've worked with for over a year to get them ready to become a homeowner, and they sustain themselves very well.
So, Jeff, I've been approved for a mortgage, but somehow my DTI changes. What do I do, and what does that mean?
Right. So, and that's very, very important. Very good question, right? And something we teach our clients is to be careful of after they've done the application is don't do anything that's going to affect your debt ratio. Don't go out and open up a new account. Don't go and have a lot of people check your credit because we're going to pull your credit one more time before we close out that transaction, right? So if you've gone out, and people get really excited, they bought the home and they want to furnish it with new things, so they go down to the furniture store and they open a new account thinking that it's not going to impact them. But sometimes another $50, another $100, $150 a month payment can mean the difference between approving a loan and not approving a loan.
Okay, so I'm going to just make it clearer for me and everyone at home. When you pull that final credit check, what is the purpose of that? If we've already been approved? Right,
to make sure somebody hasn't taken out an additional debt or something that we didn't know about, right? So we do what's called a softball right before closing just to double check things.
Okay, I understand. Well, what's the process after that second credit check? Is it closing?
Yeah, it's closing because at that point we've approved the loan. Our loan is approved subject to that final check, and then we're going to, once that's done, we're going to clear the file for closing, and you're going to be on your way.
All right. Well, we put some questions out to our viewers to ask you, and one of them came back and said, how can someone go about putting in a pre-qual application with JTS Co?
Very easy. One of the things we pride ourselves on in making the process very efficient and easy, because one of the biggest things we see is the fear is the first hurdle to overcome. People are afraid to do anything. So we have really some easy process to do that. We have a text application where they can do it right there on their phone 24 hours a day. Of course, they can go to our website and do it, and they're always welcome to come into our office and sit down and talk with us one-on-one and do an application right there.
Perfect.
Easy.
Thanks, Jeff. We appreciate you. If you want to find out more information, there it all is up on the screen, everyone. JTS Company mortgage professionals. Go over and see Jeff and the team. They're so friendly and so warm, as we've said before. Back after this short break, everyone. You're watching On the Beat.